Welcome to Market Monday from the investment team in the trust department at the First National Bank. We're going to start things off today with a review of the economy over the past month and then a look outward over the next 2 weeks to see what's happening in the future that might impact markets in general. We're going to talk about the general analytic framework for looking at how the macro economy is working, looking at the bigger picture forces that are working on this pretty amazing bull run that was not expected that we're in. Looking out at other related markets and how they typically correlate gives us a bigger picture. We're going to talk about that a little bit today, and then we'll talk about what's happening in particular in equities and rates, and potentially, or more like actually, the change in footing that we're witnessing happen over at the Federal Reserve, which we believe is long overdue. So, at the beginning of the month, we got durable goods orders and factory orders. This factory order number was really notable, coming in at a 1.5% growth when it was expected to grow by only 0.6%. Building permits, trade balance, all these things are relatively in line with the expectations. And as it happens, most of these reports are either medium to strong in their indication of what's going on in the labor market and in the broader economy. Going through this, we'll look for some more notable things. Home sales is coming in higher than expected despite rates being a little bit higher. Employment numbers are coming in roughly in line with what's expected. Initial claims, the jobless claims number, smaller than expected, but none of these numbers are meaningfully different than what the expectation is, and we're not overly concerned by what we see here. Yes, we got a pretty disappointing expectation last month for the non-farm payrolls. That's the much more important number than the ADP one I just skimmed over. The non-farm payrolls number for April, they were expecting 65,000 job created. And that's with 73 entrants who are all well-respected economists making a forecast that presumably is pretty informed. We came in close to double that at 115,000. That doesn't signify weakness in the labor market, folks. That's strength. Now, is that strength relative to historical standards? Not necessarily. It's about average, but it certainly does not suggest that we're in danger of seeing massive job losses yet. It suggests that the labor market's rather healthy, and that weakens the narrative that says, we have to protect the labor markets and cut rates. No, it doesn't really look like that. The inflation numbers, first, before we even talk about the official inflation numbers, let's talk about unemployment rate, because, in economics class, the labor market is described to be at quote-unquote full employment when unemployment is 5%. When you're under that number, as we are now at 4.3%, that suggests, according to traditional analysis, that the market for labor is actually running, a little bit hot, which is an inflationary force. We get some sentiment indicators that came in mixed to, some of them are in line or in line-ish. Wholesale inventories in line-ish. Sales came in quite a bit more, which tells us that retailers are actually focusing on buying inventory faster than the wholesalers are inventorying them, those pieces of inventory. So it tells us that the consumer, despite obvious cracks like higher rates, larger delinquent credit card balances, and things of that nature that suggest this consumer is coming under pressure, the consumer is obviously still buying things, which is bullish for the market as well. Here's the stuff that really matters. CPI, Consumer Price Index, came in as expected, but that was at 0.6% month over month. That number annualizes to much greater than 6% in terms of what that is on an annual rate. And that number is much more important than what you look at in this year-over-year number, which is also stronger than expectations, but not by as much, because the price of oil really didn't start rising until this Hormuz situation and our hostilities with Iran erupted. So we're not really thinking that we want to analyze what was going on with prices before that, when we have seen a massive commodity price shock as a result of shipping being shut down in one of the world's most important shipping lanes in the Persian Gulf. So analytically speaking, this is still, this number suggests that inflation is actually spiking and continuing to spike. it's going to continue to spike as long as commodity prices remain elevated, as long as hostilities are going on. And let's be real, folks. If the war were to stop today, there are quite a few facilities that have been shut down that will take months to years to come back online. So when we're being told that commodity prices are going to be coming down, oil and liquefied natural gas in particular are going to come down, we don't see that happening. The evidence really isn't there that that's going to happen. So as we're going back in, here's the one that's a little bit more concerning. The month-over-month rise in the producer price index was 1.4%, almost 3 times the expectation. Now, if you take this as a proxy, the consumer price index, for how much companies can raise their prices and still sell at any given level, and you take PPI as a proxy, producer price index, again, as a proxy for how much input costs are rising, you'll see there's a pretty clear mismatch here of close to 1%, 0.9%. That suggests to us that corporate margins are likely to be shrinking already. And corporate margin shrinking is how you have profits go down, earnings go down, and that's how you get write-downs in expected earnings, and that's how you get declines in stock prices, because earnings is in the numerator of most stock valuation models. So at the same time, rates are in the denominator of stock value models, and these inflation numbers are directly tied to rates. So that's also not great for stocks. When you have high inflation, the numerator is going up, or going down, or the denominator is going up, and when you have lowered earnings forecasts, the numerator is going down, and that's a double action on the stock pricing ratios. So it suggests that there could be some weakness in the market coming up as this stuff starts to really trickle down through earnings season over the next couple of them. Retail sales is still in line. Manufacturing is coming in and just blowing it out of the water. And then we've got more information that's just kind of mixed to decent to good, with the exception of inflation, because that strong is not good. But as things stand, the month ended out relatively different than what was expected. And that is, it shows strength in inflation. Inflation's a problem and it's durable. It shows strength in the labor market, which argue that the Fed has to start hiking rates instead of standing pat. GDP came in, 3.5%. That's pretty much close enough. And, we ended the month with some pretty bland data that was in line. As we go through June, we're going to see manufacturing, the Institute for Supply Chain Management. We're going to see all of these information points on manufacturing prices, new orders, employment, etc. later today, along with construction spending. Not expecting anything really to deviate from the pattern we've been seeing. This ADP number is somewhat important. They're expecting 120,000 jobs to have been created by their forecasting method or their analytic method. We don't really pay too much attention to ADP. It comes ahead of the non-farm payrolls report, which has a little bit more weight. Factory orders expected to grow by 4.5% versus a 1.5% prior. That suggests the economy is expecting to be showing some strengthening. Durable goods, the same thing. It's flat. Non-farm productivity, this is a big one. We're expecting apparently a productivity decline. Whether that happens, not really sure. We have initial claims expected to be in line, and non-farm payrolls is expected to be only 85,000 jobs. Now, we're actually expecting a quote-unquote surprise here, because that has been the pattern. The surprises have been positive quite a few times in the recent past when this report is released, suggesting more strength in the labor market than what the official narrative is. We'll get more information about the real estate markets, inflation. We'll get information about expectations, and that'll round out the next couple of weeks. So as far as intermarket analysis, there is a long-standing analytic tradition where we look at things not in isolation, because the markets are a complex dynamic system that's constantly evolving, but we look at what's happening in relationships. And generally speaking, a commodities index, this shows commodity index here, which is the Bloomberg Commodity Index, shows the actual influence of inflation, not inflation expectations, actual inflation, dollar for dollar. This is a very sharp rise from the end of 2025. It didn't actually start when the hostilities began in Iran. This was already begun. And during this whole time, of course, we're being told, oh, no, inflation's not a big deal. It's going to come back down. We can continue to just stay put and not cut rates. Well, this is about the point where they did that and prices started trickling up, showing that they lost control of inflation with that, pause rather than the about face that probably was warranted at the time. Inflation expectations change, and when inflation expectations change, that can, and in this case did, lead to durable resets in price expectations and actual prices. And now we're seeing, a spike that's on the par with the spike in commodities that led to a recession in the U.S. And there's a reason for this. Inflation is a direct input into interest rates that are, charged by the Fed for overnight lending that propagate down the curve. And that's in the denominator of stock model, valuation models. So you don't want to see evidence of inflation rising and continuing to rise, which we do. And not only that, we have some major catalysts that suggest that's going to continue indefinitely based on the hostilities that are going on over in the Persian Gulf and crimped energy prices. So, with no reason at all to think energy prices are coming down and commodities are going to come down in general. Shipping costs are embedded into commodities, and you're going to see that shipping becomes more expensive from an insurance standpoint. That gets passed along into the prices. So this is a durable catalyst, and you don't want to see it in a signal that is used to measure inflation directly rising like this. The dollar, well, let's look first at what's happening with yields. Same thing. Yields have been just going up. And that makes sense since the, 2020 at the bottom when we were in zero interest rate territory or even briefly negative interest rate territory. But as we're looking at this, you don't want to see a pattern like this. This suggests that rates are higher to stay. They've floated in this band for now 3 years-ish and not gone below this point here. And now they're trending back up again. And interest rates are in the denominator, as influenced by inflationary expectations and Fed policy, which may or may not be in alignment with reality. We see that rates are going up, and that's in the denominator of stock valuation models. Again, we don't want to see rates going up at the same time we're seeing inflation durability signals, which we are in the commodities index. The saving grace for the market is this. We're analyzing the major currency pairs, and this one here that I'm highlighting is the dollar. Pay no attention really to the percent moves. That's not necessarily terribly important. What I'm trying to show is the relative strength of the dollar appears to be top of the pack at the moment. Although, we're above the euro, we're below the Swiss franc, and we're below, of all of them, this is the Aussie dollar. This is a commodity currency that is the best performer on an absolute basis. And when I say that, most of the people out there and most analysts and researchers are using DXY, the dollar index, as the metric to gauge dollar strength. It's not really accurate in that regard because that's weighted by global trade. So that's mostly at this point a graph of the euro to the dollar cross. The euro is about 38% of that. You might as well just look at the euro if you're going to look at DXY. And trade there has been relatively stagnant. So when you take each currency, each one of the majors, and you do an index based equally weighted with all of the other ones, you come up with the value as it is on an absolute basis across the major currency pairs without regard to focus on any one currency, and you get a better sense of what's strong and what's not. And the Aussie dollar is the clear outperformer, and that again is an inflationary signal. That suggests that this inflation is likely to stay. Money has been flooding into Australia. Yes, it's been flooding into the United States somewhat as well, but that's the only saving grace on the market because that means there's more cash flow coming in potentially to buy the index. And when we look at this, here's a bull market, and here's what gets kind of scary with those inflationary, we'll call them yellow to orange on their way to red flags for this bull market. And that is, bad news, it's been going up. Good news, it's been going up even more. It's a bull market. That's how they behave. That's not unexpected. However, we have crimped corporate margins that are at a minimum under significant pressure, with input costs rising much more quickly than they can be passed along to the consumer. And then we have the commodity prices and all of these other indicators that are saying, in effect, we should expect those conditions to persist. So we do think there's an elevated chance of volatility coming later in the year that we're going to position for. We're not saying that it's going to be the end of the world, but things might get a little turbulent. As to this graphic right here, you can see that, and I don't want to make too much of this either, but this takes derivatives positions on rates in the United States across the spectrum and suggests, what the policy rate is going to be from a probability standpoint at any of the next meetings. And as you can see, we're uniformly, when this is positive, we're expecting hikes to some degree. That's what the positioning suggests. And this shows that by the time March rolls around, we're expected to have at least one hike. And along this spectrum, this is an average of all of the positions. Some of these investors in the bond markets and traders, who are among the most well-heeled and informed in the world, actually have bets for much higher than this that are smoothed out of the data that we're seeing here. So we don't know what any individual informed trader's probability is, but we can say that the market obviously expects the Fed to hike rates at the next, maybe the next meeting, maybe the meeting after that or the one after that, but there's a non-trivial probabilities, as you can see here, 20%, 28%, etc., that they're going to hike, which is an about face from what they've been saying for quite a while. It's a mea culpa of sorts, and we're glad that they're doing it because, quite frankly, we think that the cutting cycle that they embarked on was ill-advised at the time. It was going to encourage a resurgence in inflation from anything that perturbed the system, and we did see that happen. Ultimately, that would be the correct move, is for a rate hike, in our opinion. Now, what's happening in terms of yields? Well, we have a 10-year Treasury that's at 4.45. The 30-year was briefly over 5% at one point toward the end of May, and we don't see it coming down at any point in time because these longer bonds, 10 and 20 and 30-year bonds, have as their main pricing component inflation expectations, and we're seeing both the expectations rising and the actual prices rising, which suggests that that's durable. We might be in an era of just volatile rates that rise and fall periodically, but we're not going to go back to that zero interest rate environment that we got so accustomed to over the past, 6 years or, a few years after 2020. Looking at the corporate bond markets, things are a little nicer. You can get 10-year paper over 5%, and we don't want to go too far out on the yield curve. The reasoning is, in the 1970s, which is an analogous period from an analytics standpoint, you had a lot of spikes in rates and then drops in rates. And so if you're long duration, in other words, if you have bonds out here, you're going to lose more when rates spike on the dollar value of the bond. We'd much rather be positioned somewhere between 1 and 10 years on the curve and not take the what's called duration risk, but really is an inflation measure of risk. So we're building ladders that are about 1 to 10 years out, keeping a lower duration and taking advantage of these higher rates, which are great for income investors. And we're happy to see that the bond investors can both hedge their portfolio from volatility in stocks a bit by including bonds and also get paid for it. And we're going to round out this chart by going back 20 years in the S&P and hammer home a point that we like to hammer home. The great financial crisis, COVID crisis. This was the year 2018 had the worst December that I can recall on record. That may have been the actual worst December on record for the market. 2022 was a bona fide bear market, 2021, 2022. And then, we've had our challenges and drops in between as well. most recently a correction last year that was a full correction, and we're still moving up. So the point is, we're not going to panic when volatility comes in. We don't want to participate in those type of things, but we also don't want to look at this parabolic move and say, oh, this thing's going to go on forever, because eventually the music stops and this thing doesn't go on, and there is a pullback and it is getting scarier. So we don't want to lose our discipline either way. We don't want to sell when there's a panic, and we don't want to buy when there's a mania. We want to have a good financial plan in place, a good investment plan in place, and then adhere to it. Hope you found this video useful. If you have any questions, this is all complicated stuff. None of it's in a direct invitation to take some action for your particular case. You want to talk to your advisor before you make decisions based on this stuff. But at the same time, if you've got questions and concerns, want to talk about your portfolio, please feel free to reach out to us. We love to talk. Thanks. Have a great day.